following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, let me just finish doing this here. I'll show you something very interesting. 10-minute chart of the E-mini went to a peak ABCD, another ABCD. Remember, what's the objective of the Chapman Wave methodology? Try to get you from the most obvious lowest low bar to a D. You can get an instant restart. Then you can get a pattern that I call the drop bucket double top pattern. And this went to another ABCD and pulls back. Then it goes to an ABC, pulls back and screams up to yet another D and squeaks to an E, and that was below the previous high of 2110.25 made at 1440. That's 240 on the first, and we've gone into this cup formation, and now we've got a potential 1-to-1 to the downside, gone there in a quicker time frame. The test of the support of the instant restart low of 2095.50 has been made, and we are pulling back sharply. Very interesting pattern. Okay, now let's go to the numbers. Hey, thanks to everyone for the hosts that we've got, and great program today. What is today? Today being Wednesday, we'll be going, let's see, my show. Then I'm not sure Daryl's here. Daryl should be on Wednesday, Thursday. Then we've got Steve Rhodes. We've got Dave White. We've got Tom O'Brien again. Oh, programming all the way through. Great day. Let's go to the Dow. It's down 50. Let me do this. This is very important. This is such an important series of sessions yesterday, today, and tomorrow that I need to do this in a very thorough fashion. So here we go. The E-minis are down 650 at 2096. We just saw that the pattern of the drop back in the 10-minute worked beautifully. Should be finding some support right here at the 2095.50 area. We'll see if that's going to hold. Otherwise, we're going 1-to-1 to the downside, which takes you down to the 2091 area. So now let's get that out the way. We'll do our numbers. The Dow right now is down 42 points at 17,874. I've got this as a potential leg F, maybe a peak F today in the daily, leg B in the weekly, broken the week's not finished, but so far it's broken the resistance level. The 120-minute chart, oops, I missed that. 120-minute chart, that should be a D. Let me just double check. 489, 489, 4489. 45. Oh, okay. So we're going to be watching this one real closely because the 120-minute chart technicals are suggesting that we should see a pullback. I'm just going to get this, make it much smaller because this is such an important period. I want to go through everything very deliberately. Okay. So now what we're looking at is you can see that that monthly chart broke the resistance. And it's in a strong leg, what I call a gray A, because if you're looking at the 18,351 May high, pulling back to 15,370, I mean, we're talking about 3,000 points. That's a lot of points. And then to come back 2,600 points, this is very, this kind of move, it's the kind of move that you see in a V-shaped pattern. And the V-shaped pattern is seen in the weekly chart. So the technicals have to be confirming, and so for the stochastic, today's Wednesday, just the halfway through Wednesday, halfway through the week, we are at 80%, and that's a good sign for the technicals. I'm going to suggest something here that might be anathema to the bears, and even though I'm setting up and we've added to our bearish position, as well as being long, I'm looking at this and I'm suggesting to you that if we do have a very sharp pullback, I'm still looking for higher highs. I don't think we go even close to the, well, I don't even think we get to the 15,000 area at all. I don't think we get to the anything worse than the 16,000s, 16,600 or maybe 16,500. It's kind of what I'm thinking right now. But look at this. If I'm looking at if I'm looking at the Dow daily, it says that let's start looking at the downside rather than the upside. We know the upside's only got 500 points to go for an all-time high. No big deal. What's important is what are we looking at on the downside? And on the downside, 17,700 is the 9-period exponential moving average. 17,000, around about 17,600 is the 200-period simple moving average. The simple moving average is the moving average that most fundamentalists look at. They don't look at exponentials. They look at the simple because that's the one that just comes up on all the programs. And up until really about 3-4 years ago, most fund managers were really lazy as far as technicals are concerned. They did a lot of work on the fundamentals. Actually, I don't even know if they did a lot of work. They just heard everybody talking about Facebook or whatever it was, and that's what they would be buying. So the technicals, only the last 5 years or so, I think you've got a lot more technicians in the smorgasbord of analysis throughout the market. And if you're looking at that, then I'm looking at 17,321 as the 200-period exponential moving average support. But actually, it's this whole area of the millennium, 17,000, that's going to be absolutely key to any serious pullback that we get, if we get one in the next week or so. Okay, let's just get that away. And now let me look at this. The technicals on the monthly are it's the one thing that's actually kept me a little bit from becoming too aggressive on the long side. And the only reason is that sometimes they take a while, even though you can have a single leg up, sharp leg up, they take a while to recuperate, to get back again after the terrible beating that this is from 3,000 points down. And the weekly chart is the one that's the sandwich in the middle that looks horrible as the daily is already improving tremendously. And sometimes even the monthly is looking quite good, but the weekly could be terrible if there's a sharp pullback. Now let me look at it this way. The daily technicals are still very good, 93% in the stochastic. Hey, that is really good. MACD is starting to shrink. You'll see the histogram here is shrinking. So I suspect that we're really close more to a 200-point or so pullback than a 100-point up move. This is just my thinking right at this particular moment. The weekly chart is suggesting that there could be a Chapman wave squash pattern that could take us into December, maybe even January on the upside. But a lot of things have to happen, and definitely the 17,280 level to the 17,000 level, that's going to have to be a major cushion if there is a sharp pullback. Monthly chart, well, we've barely begun the month, so I'm not going to talk too much about it other than to say that's a fantastic series of 2 candles last month and so far this month. But that's just, let's leave that for now. Now let's go to the S&P, SPX.X. And what's interesting about the S&P is that I've got a G/C. Yes, you can turn down a G. There's a chance you might make the D, but most importantly, what I'm looking at here is if you're looking at, if I can just get that back again, the 120-minute chart, you'll see that 120-minute chart, the stochastic's at 86%, but pulling back very sharply with the on-balance volume, the blue line, and the stochastic is anywhere close. The MACD, the moving average convergence divergence, isn't even close to where it was when the 120-minute chart back on the 23rd of October was screaming up to the 2079 level. So that to me is a divergence that I have to take into consideration. Couple of things here. Let me just do this. I'm going to put that there and overlap it. So the weekly chart, now I think I'm going to go to the SPY because so many people look at the SPY rather than the S&P, and there's a lot, actually sometimes there's even more information on the SPY itself. So the SPY, I said the 211 to 212 area, I didn't think we'd get there this week. Well, we did. We went to 211.66, about 2 points higher than I was anticipating as a best case scenario. And that says to me, hey, you missed the resistance point. It went higher. It doesn't matter what the reason is. I think the reason was actually just plain old fund buying and catch up. But what's really important about this chart is, look, now I do want to look at the monthly because look how clean it is. Look at the number of green bars and look at the number of red bars. And that to me, just a real quick visual says there has been way more buying pressure than selling pressure, number one. Number two is, remember I spoke about this candle that if at any point the SPY was trading under 190, 150. I said maybe 191 would be safer, and holding there for 2 days, 2 or 3 days in the weekly chart, that would suggest that you're going down to retest the low. Well, we've had such sporadic and brief excursions to the downside. We haven't done that. This whole candle, this Chapman wave Roman candle near a top, should have been a warning to say, watch out. You start trading in the 189 area and hold there instead of these sudden spikes to the downside and rallies. That would be a big negative, and you'd be testing this very long-term pink uptrend line, and we're making 3 higher lows. We're not making much. We're making 3 higher highs as well, but not at all-time highs. So far, I have to conclude that this is very positive. And one of the reasons why I keep saying, yes, we might be taking a short in my opening call for subscribers. My bias is actually to be looking at where I want to be buying the indices. And now I'm going to go to the indice that is the most important. Look at this, the QQQ series. You cannot deny that if an index takes a major hit and takes 15 years to make a cup formation and then squeeze, and then in that U formation has a series of, certainly for me, Chapman wave buy modes that have gone to peak D, pull back, peak D, pull back, peak D, goes to E, pulls back, and screams up to another, and then it has an instant restart, that you cannot ignore that the upside bias towards trying to get to the 120.50 level, the all-time high back in March 2000, that was April. April was where I said, we will never again in my lifetime, boy, I hope I'm going to last long enough, we will never again in my lifetime, at least my market lifetime, see the 120.50 level again. This is a major sell signal. Well, we went 83% down to 19.76 back in October of 2002, spiked up to 54.70 back in October 2007. These October and March periods are really important for lows and highs. Scream down to the November, sometimes it's November, to the November low. It was really just on the 20th, what is that? The November low of 24.68 in 2008, and then scream all the way in a whole series of buy modes to the peak D top at 114.39. Now I'm going to make this a little bit bigger. Look right there, 114.39 in a left side, right side time match, which should have gone to, I think that was March. To May. It went to May, but in fact, that was where you would have got an exact left side, right side price time match to where? To this high of October of 2007. So when you're considering 15 years to miss by a few months, not a big deal, huh? But it says that there's so much evidence that suggests that the Qs will go to 120, and I have to consider that that's a key metric. So now we're looking at the comp index down 11, gold is down 90 cents, silver is down a little bit, high-grade copper is down, bonds are, I'll tell you right now, I'll get to bonds. We need to spend a little time. I'll be right back.
If you're looking for a great opportunity to diversify your financial portfolio and hedge against the falling stock market, consider the new market-safe Metals Hedge CD from Everbank. This 5-year indexed U.S. dollar-denominated CD gives you exposure to metals with gold and silver components and allows you to hedge against falling equities with a short component on the SPY ETF. You can earn up to 45% capped upside payment at maturity if gold and silver increase in value and the SPY ETF decreases across annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on the CD. Don't let fallen markets get you down. Get the Metals Hedge CD. The November 12th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once again, that's everbank.com/TFNN. This is sponsored content. Everbank is a member FDIC.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks, we're back. And so just real quickly, let me go back to the QQQ. Just a couple of things that I want to talk about. So the QQQ series, of course, Facebook, I believe, comes out today, so they could be a big influence. But what we're looking at, and it's interesting, FB is in the NASDAQ. Remember, NASDAQ used to only be 4-letter stocks. Now they've changed it to 2 letters as well, 3 letters. The QQQ right now is in leg E, but the stochastics at 95% on the daily, and MACD is very strong. I'm suspecting, and I drew this in, that if there is a rollover here, that the big thing will be how does it test the 112.07 support and the 109.80 the day before the gap up. It's very unusual to see gaps like this in the QQQ series. So the 109.80 level was the 22nd of October, and that was the high, and 112.07 was the low on the 23rd. That gap will be filled. Remember, gaps are like, these are like little landmarks, little icons that you're looking for. It's the same as if we were looking at a particular candle, a doji, or whatever it is, candle, or I'm looking at a round number. It's just another focal point. The rule being, I could show you gaps that have never been filled in, gaps that have gone from way back, and they just, especially when you come off a low like March of 2009, some of those gaps you might wait another, good while before they ever get filled in. That means the stocks have to go back almost to $9 or something from being at 180. So. But when you get closer and closer, then you look at the gaps. It's just like another piece of information, that's all. So I believe that 112 to 109 will be filled in. And there's an arch formation forming. When is the question? Do we get to all-time highs now, or do we have a pullback before we don't just go to all-time highs, we just spiral right through it? Is that kind of what we're looking at? I'm going to talk more about it as we move on over the next few days going into next week, and certainly for my subscribers, I'm going to be talking about that Elliott wave that I've been talking about, 5 that I believe we're in the monthly chart. So now let's go back now. So I had a whole bunch of questions, but the very first one is a leftover from yesterday I didn't have time for. The question was, is this a time to be looking at the TBT? Well, the TBT is the opposite of the TLT. It trades up when bonds are going down, yields are going up. It trades with the yield. So this is what I'm looking at. There was a failure, peak C failure in the Chapman wave is very negative, and invariably says not only are you going to go down, but you're probably going to go and retest the low and break it. Well, we've just done that. Did that yesterday. So there's a pattern here. This would be a classic pattern that you'd see here at TFNN with all the hosts. They look at, I have something slightly different that I developed over the years. It's called the Chapman wave parallel extension. And what happens is it's the angle and time. If you identify the lefts, the A to B, the rally to C, which is going to be C to D, forget about Chapman wave notation. It has to be in the same time. In other words, it took from the TLT 126.21 high of the 2nd of October to the low of the 8th. It took 1, 2, 3, 4 sessions, right? So I'm expecting that if this is going to be a parallel one, it would take 1, 2, 3, 4. Well, it took 5 sessions and it didn't quite get there. Today's the 6th. So the angle is the same, but the technique says it should have done it already, which means that in a way we're slowing down just a tad on the downside for the TLT to come down. So this is what I'm looking at, that the arch formation could be a 1-to-1 to the downside, which makes I said to my subscribers, 121 is really important. 122 was very important support. We broke that. So the next one says obviously 121, but it also says that if you start trading the 119s, you've got to expect that there's a good chance of hitting the low of 118.55. Okay, now if I can get a chance to do it, I'm going to grab, I had a bunch of questions which I will get to. I'm just checking to see if there are any callers. No, at the moment it's good. We don't have callers because I do want to get to a lot of email questions. So to have a look at this chart here, what it's saying is that the 30-year T-bond yield, the TYX, the white one, has to break above, doesn't have to close, it just has to go above 30.92, the high of the week of the 18th is a weekly chart, week of the 18th of September, and I have to immediately conclude, aha, now we've got a chance for a retest of the 32.55 high of June, the week of June the 25th. If, perchance, in the next 2 days, instead of rallying, there's just a sideways move and we start to come down, this is kind of what I'm thinking is a good possibility, then what we're looking at is just the sideways continuation, just continues for a little while longer, and you're looking at the 10-year T-note yield. The 5 years had a very big move from a lower low. This actually went, I've never seen such divergences in the yields. I shouldn't say never. I haven't seen for a very long time this kind of divergence. Let me finish the notation, and then I'm going to get to, for Julie, the XLB, for Sarah, the RUT, for Adam, the transportation and the airlines, and for GB, it will be the XLF, and I'll be right back.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Now, folks, we're back. Just got a nice email. This is from a colleague, Voices of Innocence, a concert for folks between 8 and 98 at St. Paul's Church in Brookline this Saturday, and on Sunday, November the 8th, in the West Parish Church, Andover. Really a good group, just entertainment I thought we'd throw in there. So let's look at this. So the TYX, the question I had in the den was, are you talking narrowing of the yield curve? Not really narrowing of the yield curve, but I'm looking at the acceleration of the, I haven't seen anything quite like this before. The acceleration of the 5-year so quickly to leg A, and the 10-year hasn't taken out the left side high that was made back on the 8th week of the 18th, and the 5-year took it out. This has still got a way to go to get up to the 2303 level, and trading right now at 2236. That's the 10-year, and the 5-year and the 30-year is moving way slower. So that is something I'm going to take note of. I don't know what the implication is just yet, but we'll see. Meantime, back at the ranch, so let's get out. So what I'm looking at is, I'm still saying trading range for bonds at this particular point. Look at the wood, WOOD, that's the iShares Global Timber and Forestry ETF, is in leg B, acting quite nicely now. It has a lot of resistance at 51. It's at 49.69. So this is suggesting that there is some internal strength, but it has not shown up very well in the HGX, the weekly Philadelphia housing sector index. And that's really something I'm watching very closely as well. So here we go. The question with the TLT, will it give back a full arch formation? Is it worth looking at the TBT, which right now is in leg? On the upside should be B. So it's A, B, and then I'm going to call that C for now. Yeah, so at 44.59, it could in fact hit the 45 level, which is the 200 period simple moving average. And stochastics at 84%. That says it could go a little higher. See, the weekly chart is very weak. The weekly chart is just saying daily has to prove itself before the weekly can kick in as anything. So what I'm saying is that, yes, it looks to me like yield, the TLT trading at 121, seeing some pressure, but as of now, I think it's still within this fairly narrow range. Now let's get out of that. We're going to go straight to the questions. Question number one, Julie, XLB. This is the materials ETF. It's in leg C to the upside, so it should still go to D. It's at 45.49. It has the 46.29 200 period exponential moving average that I think is going to be the resistance that it's going to try to test. And it hasn't been there since it broke down, gapped down right at that level, 29th of June. It was up at 49.17, and it kind of slips a little bit, and then it starts this slalom dance all the way down, the little hills that it goes, and then it makes a lower low. So there's a doji. I spoke about this a little while back. 38.85, 38.83. The 38.83 low was with a doji candle. I love these tiny little doji candles. I'm not sure even why I didn't buy it, because I was just thinking that if it would be a bounce and that there would be a lot of resistance. In fact, it's done beautifully. It's gone from 38 to 45, 7-point rally. What am I talking about? 7 point. That's a 7-point rally. And it should try to make its way to the 46. How it holds is going to be very important, because if over the next 2 weeks, the XLB doesn't pull back to more than the 9-period moving average, between the 9-period moving average and the 200-period moving average in the weekly, so it's got 44 to 43.5 support. If it takes that out and holds under that, that's not good. But if it just hits it and then bounces, I have to look at it and say, hey, maybe you're the next one that's going to start moving high. But in the meantime, it needs to fulfill the upside. Very good technicals. 120-minute chart says peak A, B, C, D, E. Yep, it's pulling back. I suspect there's going to be another little pop to the upside. Then you got to be somewhat careful. So I hope that helps you there, Julie. Next thing is Sarah wants to know about the RUT. I'm going to go to the IWM, because that's what most people look at. They don't always get the indexes. So the RUT index is the IWM iShares Russell 2000 ETF, trading in leg D, possibly a peak D today, right at the 200 period. I think by now, many of you are getting to appreciate the time that I've spent choosing which moving averages are most important. Look how important this 200 period moving average has been, this little coral colored orangey moving average. You see that it was support, bam, it runs up to 129.10, comes back, makes an arch formation peak B minus, goes down to a C. A minus goes down to a D and an E, a B minus, and it goes down to an F. Has a big rally in time, makes another larger arch formation, and then it breaks to a trough G. Now it starts another move with a little double bottom, and it goes to a leg, a body. We were expecting the neck, and this is the neck. And now we're going to expect to see the head, and then a pullback as the beak unfolds. So I'm making that pink. This is really the head right now. HEAD, and we'll see the beak. And this, I'm drawing it in because I think this is the scenario that is a very high probability scenario, with a pullback starting maybe already, but I wouldn't be surprised if by next week we're seeing some kind of a pullback. And all you have to do for this stalk leg formation, leg, body, neck, head, is to come back and go into under 117.14. No big deal. 60 points. No, what am I saying? 86 points. And if that happens, what we're looking at is Where it stops is going to be very important. Remember, when the beak finishes of a stalk leg formation, there's a powerful rally, and then you're on your own. You have to use other techniques to see what happens after that. So that's the IWM. Let me give you the numbers. Upside has a lot of resistance in the 119 to 120 area. 120.82 is the 200 period SMA. I don't think it's going to get there just yet. It needs a little time. That's just my thinking right now. We'll see what happens. But in the meantime, the weekly chart has improved tremendously. The weekly chart is saying that between the daily 116.64 9-period moving average and the 115.91 9-period moving average of the weekly, there should be quite a bit of support there, all the way down to 115.5. It could even go to 114.81. That's 4 points. That's a big pullback. I'm just saying step by step, 116.60s is the first real support level that I'd be looking at. Okay, that's the IWM. Weekly chart is improving, hasn't crossed positive in the MACD, but the stochastic is at 48%. That's good. It's not great. It's good. And of course, I've looked at the monthly chart, and it's unbelievable how that up channel support held, and it went into the what we call the buy zone, and it was, in fact, at least for the short term, a buy zone, and that's very important. And it's just testing the 9 EMA resistance in the monthly chart. Is it going to make an all-time high? I'm going to answer that question not just yet, on this very next pullback. So early next week, I'm going to be discussing, certainly over the weekend. I hope I'll get a chance to do it and have a real busy weekend. But I hope to get an outlook, an overview with the chart formations and the patterns that I'm looking at for the coming 2 months, going into, so it's October, going into the end of the year, 2 months worth of actually probably going into January worth of information that I hope I can get out. So that's IWM. Adam wants to know about the transportation average, IYT. IYT right at this particular point, I'm having a tough time. It's absolutely an oval pattern right there. Higher highs and then lower highs and then lower lows and higher lows. So let me put this in like that right there, a little extended. And it's saying that either it's going to be an arch formation and failure, or you're going to have one more pop up to a leg D. As it's standing right now, the weekly chart says this is really tough. The technicals improved tremendously, but the price has gone nowhere. So I'm saying that the IYT is a tip-off to say that we've got to be ready for some kind of a pullback at some point quite soon. I'm calling it a pullback. I'm not talking about a massive decline. At least for now, I'm not seeing it. So let's just deal with it as we're looking at numbers. iShares Transportation Average ETF trading at 146.82. My thinking here is that you've got, if at all, the 200-period moving average acts as a magnet, it means that if it's trading at 146.82, down 64. If it gets to 148.10, I think there's a real good chance it's going to hit 148.79, the 200-period moving average. If it touches that, then I think we're going to a leg D, the neck of this particular pattern, above 149.82. On the other hand, that's the reason why I don't want to trade it. I don't want to say, hey, like an economist, on the one hand, we could go up, but on the other hand, we could go down. It's not good enough. These are parameters I'm looking at. On the downside, a close below today's low is a hint that if there is a close underneath that doji candle low of 145.74, it's like a point away from where we are, there's a real good chance we're going to retest the candle wick of the 28th of October and go to 143.51. That's what the weekly is saying. Weekly is saying is you're just stuck. Don't get carried away. You don't have to go short. You don't have to go long. Now, Adam asked the other question, which I think is just as important. Oh, I had the truck. Let me do that in a moment. I'll try to find it. This is a peak D in the XAL, which is the airline. This is the ARCA airline index. Monthly chart has improved a little bit. Weekly chart has improved to the point where I can say it's making higher highs and higher lows. Technicals are good. So far, it's saying it's a little bit more positive than the IYT transportation index, although it looks quite a bit like it. It's a little bit more positive in the weekly. Why? Because unless it breaks at 92.37, down $1.38, unless it takes out the low of last week, no, unless it closes under the low of last week, 90.37 or lower, I'm suggesting that it's just stuck for now. And stuck for now might just be very short term, or it could stay this way for a while. You remember rectangle formations, This is not really the oval. This is closer to the rectangle. And rectangle formations can last a lot longer than your patience. So I hope that helped you. Oh, a breakout, certainly a breakout above 94, above this peak D. 94.40 starts a breakout and says that the simple moving average becomes a target of 95.78. Just wanted to be clear about that. Okay, so now we get to the XLF for GB. So GB wants to know, what about it? Well, I like the action. I think the low that was made on the 2nd of October at 21.98, let me put that in, 21.98, 10.2. That low, make it green because it certainly is a green, this has gone all the way to a D. Any way you count it has gone to the D. And this is, there's a high level consolidation. The weekly chart is actually quite good. After that candle, that August candle, I would say that this is very good action. And what's really important about it is that the monthly chart is above the 9-period moving average. And that says to me that the XLF is in play. Remember, we've been looking at the XLF for a while, deciding whether or not the XLF is going to be one of the players in the next big move up. Well, if it's a player in the next move up, we've got to look at those bonds. Now, I just don't see, if the Fed's going to do anything, they have to do it right now. And they have to say, in December, we're going to raise rates. Oh, there's an 80% chance we're going to raise rates. But they kind of stuck, you know. I don't know what they're going to do. So in the meantime, XLF looks really good. I would suggest that it's at 24.39. If you don't have anything, you know, if you want to nibble here, knowing that you're only starting a position, that's one thing. But the real buy assessment, not the entry point, but the assessment of what's happening is between 24.10 and 23.70. Hanging around that area says, okay, now's the time to make a decision based on the weekly and the monthly charts, whether or not to be aggressively long, to be short-term long, to be a small position long, to be core long a certain amount and say, I'm going to add to it on the next big decline, wherever it comes from. That's where you want to make your decision. Let's go to Mohammed in Glendale, California. Mohammed, how are you?
How are you doing, Basil?
I'm well, thank you.
Wonderful. I was wondering if you could take a look at BlackRock, BLK.
So I just need to make a quick assessment here. BL, is it BLX?
BLK.
Yeah, no, I just wanted to BX. What was I looking at? So BLK is BlackRock. Is there a Blackstone? What was I looking at this morning that I looked at, which is just great? I wrote it down. Oh, BDX, right. Give me a second. No, BDX is Becton Dickinson, which is doing extremely well. Yeah. Oh, it gapped up today, Becton Dickinson. I just wanted to make sure I was looking at, because I notated something very in great detail. Of course, I wrote it down somewhere here and I can't find it. Oh, it doesn't matter. Let's go back to the BLK. Do you have a position in this?
I do. Around these prices, actually.
Oh, have you sat through all the way from the April-May high down to the low in the 280s and then back again?
Correct. Yes, I've taken a ride all the way down, and I'm coming back to my price, actually. So I was wondering if to hold it or let go of it.
Okay, so now, all right, now there are a couple of things. You know, you've heard me say this, I'm sure, before. When you've sat through almost a 1/3 decline of your stock, and then you come back again, that's completely different to just buying it and maybe being down a little bit. So I want to take this break that we've got coming up. I'm going to do notation of this BlackRock Inc. trading at 357, down 74 cents. It looks fantastic on the daily chart. It's great on the weekly chart. Give me a second here. I want to talk about it. And then I'm going to congratulate you on holding on. And then I'm going to scold you. You know that. I'll be back.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Hi, folks. We're back. Let me just do this. There was an alternate count here, so I need to put an F/A and then an unusual G right there. All right, so this is a very interesting chart. Now, first of all, the praise. The praise is that you stuck in, you believed in the company, and now you're back to where you were, and that says congratulations. The other is that when you've sat through a decline that you didn't expect, it wasn't part of your plan, when it gets back, I have a rule that says you either, as soon as you get back to break even, you have to, regardless of tax consequences and everything, you have to consider that you want to either sell immediately and then step back for an hour or two or a day or two, and you have to say to yourself, would I be buying it now? Thank goodness I'm back to even, and would I be buying it? And if you are, you can go right back in, even if it's a point higher or two, doesn't matter, or a point or two lower, because you believe in the stock. Or you have to tighten up your stop so that you just absolutely do not go through that again. So that's the positive side. The other is that I don't know if you use stops, or in this particular instance, it kind of got away and it's a high price stock. So you say, you know what, I'm just going to hold it. It should come back. It should, oh, man, you better come back. But oh, thank God it's come back. And if that's the attitude, then that's the reason why we want to have stops. And if you had, I don't know if you would have rebought it much lower down, but if you got out of it, say with your 10% or 8% stop, then you would have had an opportunity at any point on that double bottom, that internal low with the residual low that was made back in August when it slumped down to 275 round number. Oh, round number, I didn't even see that. 275 round number low. What a nice entry point. Okay, and then you could have gone into it again. You would have been up and you would have had a completely different psychology. I don't have to tell you this because you've been through it, right?
Correct.
Okay, so now what's the issue? The issue is, I would suggest to you that some part of your portfolio on this stock has to have some kind of a stop in. At 357, you've sat in all the way to 275. That means you'd be comfortable if it pulled back to the 335 200 period moving average, which is like a 10 or 12% correction. So I would say to you, maybe you should have say a 13% stop, somewhere around 330, that if this takes a dive again, you don't want to go through what you went through. That's number one. Number two is there could be something else that you do, and you say to yourself, you know what, thank goodness I'm back. Even if it goes higher, I'm going to take something off just to say, thank you, trading gods, for giving me the opportunity to get back to even, because that was a huge, it's almost 100-point rally from the low, and that's a gift. So now I'm going to set that aside. Now the question is, I look at it and I say, would I buy it or would I sell it? Right now, it looks to me like it's a little overbought based on the 120-minute chart, based on the daily chart, even the weekly chart. But it is a very strong stock, and it looks to me like it's a stock that's been in the focus of fund managers, and therefore I would like you to be able to hold the stock longer. So that's my thinking. On the other hand, I am going to say to you, because you went through it before, you can make the decision how much, but some part of your portfolio, including this stock, has to say, this stock is a big, it's a high price stock. I don't want to go through a 100-point decline again. I'm prepared to make the stop 30 points, 10%, or 40 points, 12%, something like that from here. And then if it drops that much, I'm out of it, and I'll reassess whether to buy that portion back again. But I do think you need to think of the stop. And the other thing is, right at this level, 357.49, leg E, beautiful technicals. I think it's very close to some kind of a pullback. So that's my suggestion. Think about taking a little bit off or putting in a stop just to protect yourself. But it's really a nice looking monthly and weekly chart. We'll look at it again maybe Tuesday. Okay, Mohammed?
Okay, thank you so much, Basil.
Thank you, folks. Stay tuned for everybody. I've got a great lineup. Check my opening.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.